As of 12:18 p.m. Eastern Time, Nuburu Inc., ticker BURU, is trading at $0.3950, pulling back slightly by 1.25% on the day. But that price, that small percentage, tells you absolutely nothing about what is happening here. The real story is the volume. Over 107 million shares have already traded hands. To put that in perspective, this is a company with a total market capitalization of roughly $31 million. The entire company, theoretically, has been bought and sold almost 3.5 times over since this morning. This is not normal investing. This is a battlefield. This is a high-velocity rotation of shares, indicating that BURU has become a pure trading vehicle, divorced from its immediate fundamentals and operating entirely on a powerful forward-looking narrative. The expectation, the story that is driving this incredible volume, is a complete and total reinvention of the company. On October 22nd, Nuburu announced a strategic framework agreement with Maddox Defense to form a controlling interest joint venture. This JV is not about Nuburu's legacy technology. It's focused on building next-generation drone systems for military and commercial use. The press release was packed with enticing figures, projecting a target of $100 million in annual revenue by the end of 2028, with a cumulative $165 million expected between 2026 and 2028. For a company that, as we'll see, has struggled to generate any significant top-line figures, these are astronomical projections. This new venture is slated to be established under Italian law, positioning it as a European manufacturing and research hub targeting NATO and allied customers. This single piece of news is the match that lit the fuse, creating an expectation that BURU is shedding its failed past and attaching itself to the booming defense and drone sectors. But this isn't an isolated event. It is the capstone on what the company calls its transformation plan. This plan has been unfolding at a rapid pace. Just days earlier, on October 16th, the company announced it had regained compliance with the NYSE American, a critical step for its survival as a publicly traded entity. This came after an October 13th warning letter from the exchange, not for its finances, but for failing to provide advance notification of its October 1st announcement of a new dual CEO structure. Before that, on October 7th, Nuburu announced it was acquiring Orbit SRL, an Italian SaaS provider focused on operational resilience, again pushing the company further into the defense and security software space. This is a flurry of press releases, a rapid-fire sequence of acquisitions, joint ventures, and management shuffles designed to convince the market that this is no longer the BURU they knew. This is an aggressive, fast-moving pivot. So what exactly are they pivoting from? This is where the expectation of a high-growth defense contractor meets the brutal reality of Nuburu's history. Many investors who bought in during the 2023 SPAC boom remember the original story. Nuburu was supposed to be a leader in blue laser technology. This technology, on paper, is fantastic. Its unique wavelength is highly effective at processing metals like copper and aluminum, which are notoriously difficult for traditional infrared lasers. The primary markets were supposed to be e-mobility, specifically welding the copper foils and tabs in electric vehicle battery manufacturing, as well as 3D metal printing and consumer electronics. The addressable market was huge, the technology was protected by patents, and the future seemed bright. The stock in early 2023 reflected this optimism, trading at a high of $560. The reality, however, was a catastrophic failure to execute and commercialize. The company's financial performance has been, to put it mildly, abysmal. We are looking at a company that, according to recent filings, has a trailing 12-month revenue of just over $150,000, while posting a net loss of over $37 million. Some data sources even peg the revenue closer to $9,000. Either way, it's effectively zero. The company's own reports from earlier this year showed it had only 8 employees. This is the context for the 99.9% collapse from its all-time high of $560 to its all-time low of just $0.125 hit in September 2025. The market's verdict was clear. The Blue Laser business as a standalone venture had failed. The transformation plan isn't a pivot. It's a desperate attempt at a complete corporate resurrection. This history is why the online discussion, particularly on forums and social media, is so deeply divided. You have one camp of bulls looking at the Maddox Defense JV, the Orbit acquisition, and the $100 million revenue projections, believing this 40-cent stock is an asymmetric bet that could return to $5 or $10 if the new management team delivers. Then you have the skeptics and bears, pointing to the history, the 99.9% value destruction, the 8 employees figure, and labeling the recent flood of news as a classic pump and dump, driven by dilution and buzzwords. One of the most common accusations you'll see is that the company is a serial diluter, which is a hard claim to refute, given that on September 16th, Nuburu closed a $12 million public offering. Comment below if you think this pivot to the defense sector is a genuine strategic shift by a new team or just a desperate attempt to create a new narrative for a failing company. This brings us to the short-selling activity, which is one of the most complex and fascinating aspects of this stock. When you have this much volatility, dilution, and narrative-driven trading, you attract short sellers. But with BURU, the situation is extremely unusual. The standard short interest percentage is notable, but the real story is in the fails to deliver, or FTD, data. Fails to deliver occur when one party in a trade fails to deliver the shares by the settlement date. While this can happen for administrative reasons, massive, persistent FTDs can be a sign of settlement system stress, extreme volatility, or, in some cases, naked short selling, where shares are sold short without being borrowed first. Let's look at the data. The SEC's FTD data for September 2025 is staggering. On September 16th, the day the $12 million offering closed, there were over 6 million shares that failed to deliver. The next day, September 17th, that number spiked to 8.7 million shares. There were other spikes too, like 4.8 million FTDs on September 4th. For a stock that was trading near its all-time low, these are astronomical numbers. It is highly likely this was directly related to the chaos of the offering, with market makers, arbitrage funds, and short sellers all trying to navigate the massive influx of new shares. The offering provided a huge pool of locates for shorts, but the settlement system appears to have buckled under the strain. For an investor, this is actionable information, but it's also a warning. You can find this data directly from the SEC's website or aggregated on platforms like Fintel. When you see FTDs this high, it tells you the stock's plumbing is under severe stress. It also highlights the risk of chasing a supposed short squeeze. While bulls might see 8.7 million FTDs and scream manipulation, a pragmatist sees a company that just injected $12 million worth of new, cheap shares into the market, which is the exact opposite of a squeeze setup. The FTDs were likely a temporary technical dislocation, not a sign of a trapped short position. What's your take on those massive failed-to-deliver numbers from September? Do you see it as evidence of a coordinated short attack, or just unavoidable chaos from the $12 million offering? So, where does this leave investors? The future outlook depends entirely on which reality you believe. The path forward is a high-wire act. The bull case rests entirely on the new management's ability to execute its transformation plan. The Maddox Defense JV is the key. The agreement is not definitive. The press release stated the parties intend to execute a definitive agreement on or before December 15, 2025. That date is now the single most important catalyst for this company. If that agreement is signed, and Nuburu can successfully integrate its acquisitions, the $100 million projection, while ambitious, becomes the new baseline expectation. The stock could, in that scenario, find a new, higher floor. But the risk is monumental. The company is, at its core, a $31 million shell with 8 employees, a history of failure, and virtually no revenue, attempting to manage multiple international acquisitions and a complex defense sector joint venture, all while fending off compliance issues, as evidenced by the recent NYSE warning letter for a simple communication error. This transformation is being funded by dilution, which puts a constant ceiling on the share price. If the Maddox JV definitive agreement is delayed, or if its terms are less favorable than announced, this 107 million share volume will evaporate as quickly as it appeared, and the stock will be left to trade on its non-existent fundamentals. In the end, the story of BURU is a perfect case study in expectation versus reality. The old expectation was a high-tech blue laser company that could power the EV boom. The reality was a 99.9% collapse. The new expectation is a nimble, high-growth defense and SaaS conglomerate. The new reality is that this conglomerate is just a collection of press releases and a $31 million market cap funded by dilution and trading 107 million shares in a single session. The market is